Hi, you're listening to What's the Deal, our investment banking series here on JP Morgan's Making Sense podcast channel. I'm your host, David Rawlings, country head of JP Morgan in Canada. Today, we're exploring the current state of the IPO market. Joining me is my friend and colleague, Keith Canton, who leads America's Equities Capital Markets. Keith, welcome.
Thanks, David. Really appreciate you having me today.
Listen, before we dive in, why don't you just spend a minute to tell our listeners a little more about you and your role here at JP Morgan?
Yeah, absolutely. I've now been in banking for over 20 years, but I actually started my career in publishing at Sports Illustrated magazine. Currently, I run the America's Equity Capital Markets practice, so really responsible for all of our IPOs, public equity, but also our private equity placement business as well. When I joined JP Morgan 9 years ago, I was hired to actually found and build out that private capital markets platform.
So we get lots of questions from the 20-year-olds who say, how do we get into banking? How did you make that shift?
Well, coming out of Sports Illustrated, I was not quite qualified to make the leap specifically into banking. So for me, my route was going into business school. And I ended up joining Lehman Brothers as a summer associate in 2001 and a full-time associate in 2002.
And where'd you go to school?
I went to Fuqua School of Business at Duke University.
Go Blue Devils.
Yes, sir.
Awesome. Listen, I had Lorenzo Soler, who is our global head of equity syndicate and a very good partner of yours. And we talked about IPOs. And before we continue, let's just play a clip from last year's discussion with Lorenzo.
In terms of what are investors looking for, what types of quality businesses are they prepared to buy, I would say there's massive focus now on structural growth stories with profitability. The days of 30-40% top line with less of a focus on bottom line are behind us for now.
What he said was there was this shift away from high growth, unprofitable to more disciplined and profitable. We'll get into this in a second, but when we think about year to date, volume is about $15 billion, up materially from last year. So I shift to you. Is the current activity consistent with that approach?
Yeah, I think Lorenzo was spot on. When you take a step back, on the face, the market looks quite positive. The NASDAQ, S&P are both effectively at all-time highs, and really equity capital markets are up across all products. Follow-ons and blocks are up a combined 65%. Converts are up about 65%. And I know we're going to focus here on the IPO market, but the IPO market right now is running about 2x what it ran last year. And you're spot on, $15 billion raised year to date versus just under $20 billion for all of last year. So we feel quite good about where things are.
Now, I would say 2023, that's not your benchmark year because that was still a tougher year, 22 and 23. But 15 billion, if you put that into context over a longer period of time, feels pretty healthy?
Yeah, the way we think about it is pre-COVID, we were running in the mid-40s from an IPO volume standpoint. That clearly jumped up to a peak of well north of 100 in 2021. And then we dropped to 7. And so we're coming off of all-time lows, 7, 20. And based on what we're seeing, we would expect the IPO market to end up in the 30s from a volume standpoint.
Good. So almost back to normal. But, it's been dominated by some big deals. And you might want to highlight a couple of those particular transactions for our audience.
You're absolutely right. When we think about where we are in the market, maybe just taking a step back, deals are getting done and they're getting done well. The deals are working. They're getting done across all sectors. And to your point, they're actually getting done in size. This year, the average deal, the median deal, when you take out biotech, is close to $700 million. So we're seeing quite sizable deals. And this year, we've already had $4 or $5 billion plus transactions, which is really showing the investor sentiment to get transactions over the finish line.
And when you say investor sentiment, take that one step further. Is it a different type of investor that's showing up today versus last year? What's the composition and how's that changing?
I think the biggest positive we've seen this year is really much broader participation across the landscape. So the mutual funds have actually started to come back in a very big way. And you're also starting to see generalist portfolio managers come back into the market. And what that does is it really allows for larger IPOs, but to get those IPOs placed with really fundamental investors. So we're reducing the reliance on sector-focused portfolio managers who might be size constrained and hedge funds who might be more likely to churn in the aftermarket. And so the marginal IPO dollar, we can actually place that now into stick your hand. So it's really good to see the mutual funds and the generalist PMs come back into the market in a really material way.
And then what about across sectors? Is it consistently strong across sectors?
Historically, technology is the dominant sector within the IPO market. We're not really there. In this market, we've seen 5 tech IPOs this year out of about 30. So we're seeing broad spread participation, consumer, industrials, financial services. Insurance has been a big part of the market so far. And then healthcare. Healthcare services meet Lorenzo's threshold of big scaled, profitable businesses. But you're also seeing biotech as well. We are seeing deals get done across all sectors. But interestingly, deals are also working, which I think is also leading investors to want to get back into the IPO class. This year, if you strip out biotech, 80% of the IPOs in 2024 are above issue price. And the median IPO is up about 20%. So the deals are working, and that's really leading people to view the IPO product as a source of alpha once again.
All right, so let's strip that down in a few different ways. So you mentioned scale and profitability. I've also heard you talk about durability. So just go a little deeper on kind of what that means.
When we think about what is an attractive IPO candidate, we always come back to scalability, profitability, and durability. So are the companies really sizable? If not, can they become sizable companies? Are they profitable today, or are they on a very clear path to profitability in the near term with a high degree of visibility? And then are these durable business models? Are they providing a service or a product or solving something that is really going to be around if the company decides to remain independent for the next 5, 10, 15 plus years? Do the business models really have durability to them? And what you're seeing in the class of 23 as well as the class of 24 IPOs, companies are checking really all 3 of those boxes. And if you're doing that, you're going to get rewarded with an appropriate valuation, but also the right types of investors. And if you can only check 2 of those boxes, and we've seen a couple of examples of big companies, real business models, but not yet tipping into profitability, those companies are pricing and seeing much more muted aftermarket performance.
And then when you talked about aftermarket performance, why is that important?
I think it's important for a couple of reasons. First and foremost, people tend to think of the IPO as the event, but it's really only the first step in the journey to being a public company. On average, most of the IPOs are selling anywhere from 10 to 20% of the company, which means you've got 80, 90% plus that still needs to be potentially monetized over time. And so if you show some early gains to investors and you perform quarter after quarter, you're going to have a following of investors who are going to be there to help you monetize your stake over time and really get you the maximum value for that residual 80% stake versus trying to maximize out that first 10 or 20% stake.
Okay. When you think about the potential headwinds, there's geopolitical tensions, there's other things going on. What are you hearing in terms of pushback from the investor? And can you put some numbers around that?
I think investors want to deploy capital, but they're mindful that we are still facing headwinds. Inflation and labor costs are still up, and that has a big impact. In the consumer sector, we do have geopolitical risk, which is incredibly hard for an investor to handicap and to price in the right amount of risk premium there. And so when you think about all that, investors want to make sure that they're coming in at the right price. And so what we've experienced is the traditional IPO discount has widened out pretty materially. Historically, we would have thought about a traditional IPO discount of plus or minus 15% when measured against what the market perceives to be the closest comparables. In this market, we're seeing IPO discounts of 20, 25, in some cases, just north of 30% on that same basis. So investors are incredibly disciplined to make sure that they're getting in at the right entry price. And part of this goes back to the lessons that they learned from the class of 21 IPOs, where 3/4 of those IPOs are still underwater today. So investors, I think, are showing a heightened degree of discipline in today's market.
Well, to your point, it seems to be working. As long as the company has appropriate scale and that business model is durable, there's interest. It's just you have to figure out at what price. And I think finding that intersection is what we do really well.
I think that's spot on. We're very fortunate. We get to see a lot of high quality companies, and we have the opportunity to tell those stories into the public markets. And so for us, it's really making sure we get that balance of scaled business that's showing real growth, but is also very focused on profitability. And when you take a step back and think about what the market is telling us about profitability, we've seen almost a 5x change in the relative importance of profitability to growth when we measure those in an analytical way. So the market is very much focused on profitability, but I always come back to the fact that the IPO market is really predicated on growth. It is a growth market.
You had mentioned your structured equity background. I know you spend a lot of time with private equity and structured investors, and private equity has become a much bigger part of our market over the course of the last several years across credit and equity. But if you're in this environment where companies need to be more mature, how does that impact them? And what are you seeing as it relates to your market?
I think the current setup of larger and profitable companies actually plays quite well to where sponsors historically have invested their capital. When I think about the IPOs we did this year for Viking Cruises and UL Solutions, those I think provide quite a good read-through to how sponsors might think about their portfolio companies. Those were both billion-dollar plus IPOs. Those are both very profitable businesses with fairly low leverage on a relative basis. But importantly, over 80% of the proceeds in both of those transactions was secondary back to the existing shareholders. And so if you're a financial sponsor that is really focused on how do I return capital to my limited partners, those two deals in particular, and there's been a few others, really, I think, provide some positive signs of life. And so when we're having our conversations with the sponsor community, we've absolutely seen a pickup in the preparedness of financial sponsors to want to get their portfolio companies out into the public markets.
Is it uncommon to see that much secondary stock in an IPO?
Historically, when you were in a growth market, that would be very uncommon because the companies really needed to raise the capital to grow their businesses. But in a world where the companies that are going public are already profitable, you really only have a couple of use cases. You can repay debt, you can think about acquisition capital, or you can give the capital back to the selling shareholders. And so just with the shift in the size of the companies, the profitability of the companies that are accessing the public markets today, we're actually not surprised to see secondary proceeds be a very accepted use of funds from the buy-side community.
Okay, so that covers more traditional private equity. And how does this impact the venture community?
The venture community is clearly one of our important constituencies. And what they're experiencing is they're waiting a little bit longer to access the IPO market because they want their companies to grow into a sufficient scale that they'll be attractive in the public markets. Historically, we would have thought about a company with $100 million of revenue being public company ready. That was an IPO in 20 or 21. In the current environment, those same metrics are probably closer to $300 or $400 million before you're of sufficient size and scale to really attract a mutual fund or a public company investor.
Got it. So let's just shift for a minute. Here we are halfway through 2024. As we think about the back half of the year, obviously we got an election cycle, which we won't spend a lot of time on, but what are you hearing from investors in terms of their appetite? Do you think this market will remain resilient as we get through the summer and the fall?
I think the summer and the fall should be fine. When we look at the companies that we have in our backlog and we take a look at what we believe is going to come across the street, I think you'll see a pretty healthy issuance cycle for the balance of this quarter, Q2, which is really June. Then I think you'll see a pickup in July. A number of companies are shooting for that July window. And then ultimately, we're going to get into the fall. And I think the bulk of the issuance will really come in September, October. Most of the clients that we're speaking to really want to get ahead of the election to the extent possible. And once you get past the election, your windows with the year-end holidays tends to get fairly limited. So I think we'll see a fairly active next 2 months, and I think we'll see a fairly active September, October. And then it might be a little quieter than we would historically think about for the balance of the year.
And my guess is, just given the time it takes to be ready to go public, you've already got a pretty good lens on that.
We do. I mean, we're having organizational calls and kickoff calls for companies that are looking to IPO in October. And as we tell our clients, if you really haven't picked your banks, picked your law firm, and are well down the path of the IPO process, you're really looking at 25 at this point.
Okay. So listen, we've covered a lot of topics. Let's just bring it back home. We're in the advice business. You spend a lot of time giving advice to issuers. You also understand deeply what the investor wants. Can you just talk about what advice you are giving to corporates today?
I think two things really jump out at me when I think about what companies oftentimes don't think about when they're ready to go public. One is, how do you want the public markets to view your company once you're public? What are the KPIs that you want to be able to tell quarter after quarter that you want to be judged on by the market? So start thinking about what those KPIs are today. Start thinking about how you're tracking those KPIs today. And that's critically important. A lot of times companies get to the public market and they haven't really thought about what narrative they want to tell 1, 2, 3 quarters down the road. So I think that's particularly important. The other thing that we always focus on with companies is make sure you can predict your business. The public markets reward consistency and predictability. And so as you think about putting the financial model together, you want to balance being aggressive with what can you actually deliver. And there is nothing that destroys credibility for a newly public company than missing the market's expectations in the first couple of quarters. So those would be the two things that, as we think about advice to our potential IPO clients, that we really try to hammer home.
Yeah. And then I think the third one you touched on earlier, which is investors recognizing that this is a market you can get sized on, but you have to be less sensitive on discounts. Let's get a successful deal done. Let's set ourselves up for multi-quarters of performance, and then we can continue to monetize into the future.
Spot on. There is a lot of equity to sell once you become a public company. The IPO is incredible, but it's just one step on the journey to being a public company.
Well said. Okay, good. Listen, to recap, today we explored the IPO market. We discussed the recent uptick in activity, the changing landscape, and some notable trends across sectors and regions. Big thanks to you, Keith Canton, for joining me. Valuable insights as always.
Thanks for having me, David.
And thank you to our listeners for tuning in to another episode of What's the Deal? I'm David Rawlings. Until next time, thanks for listening.
Thanks for listening to What's the Deal? If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. To stay ahead of the curve, sign up for JP Morgan's In Context newsletter, packed full of market views and expert insights delivered straight to you. To subscribe, just visit jpmorgan.com/in-context. This material was prepared by the investment banking group of JP Morgan Securities, LLC, and not the firm's research department. It is for informational purposes only and is not intended as an offer or solicitation for the purchase, sale, or tender of any financial instrument.